The global economy over the past centuries has witnessed a wide range of economic crises, often occurring from inflationary pressures or offshoots of deflation. But the dynamics of the global economy are fast changing, and more recently, a growing number of pretending crises are beginning to appear inevitable. And this time around, they are stemming from the much conservative economic phenomenon of stagflation. It's been well over 50 years since the earliest impacts of stagflationary pressures were observed within the US economy. This was a period when the inflation rate remained an unwavering 12%, and one during which Americans had to spend hours queuing up in long lines just to get gas, owing to very accurate rationing policies that were largely in place in the early 1970s. In today's video on your favorite finance channel, we'll be detailing what stagflation is and closely examine its debilitating effects on the global economy, as well as just why there's a rising global concern that the world is about to experience its great stagflationary pressure yet. But before we get into all of these, kindly support this channel by giving this video a thumbs up, hitting the subscribe button, and smashing that notification bell to receive updates of when we post more intriguing finance videos like this one. Do leave us a comment as well, as we'd love to read your opinion on why the world might just be on the verge of getting plunged into its worst financial crisis yet. For easier comprehension, we'll start by first lucidly explaining what stagflation is. Thankfully, the word stagflation is a compound word, and as is often the tradition with compound words, it's largely self-explanatory. The first part of the word stag is an abbreviation for the fuller word stagnant or stagnation, and refers to an all-around stagnant economic state. In broader financial and economic parlance, it describes a state in which a country's economy grows at a very slow rate, experiences no growth at all over an extended period, or practically recedes into negative growth. It is also characterized by an unusually high unemployment rate, with these two core metrics of a stagnant economy making it one of the worst-case scenarios of all devastating economic states. The other part of the word "flation" is simply a short word for inflation, which, when added to the mix of a stagnant economy, births stagflation. Inflation, as is more commonly known, describes a period of abysmal rising prices for basically all essential commodities produced within an economy. Independently, either of both scenarios is bad enough for an economic state on their own, but when they occur simultaneously, well, that's even more deadly. Stagflation is therefore essentially a period of a very weak economy and persistently high inflation. When the first stagflationary pressures held the US economy by a lifeline, one evident fact is a large majority of us watching this video have either not been born or were probably too young to make any sense of it. Not 2 years after the global pandemic, it appears that the world is in a deflation overdrive, a proven preliminary phase to full-blown stagflation. In the US, the inflation rate is presently at a staggering 7.5% and well above the acceptable 2% threshold. But for the bulk of Americans, even this recently released inflation reading is considered largely conservative. Food prices are especially experiencing prevalent double-digit increments. Rents are likewise up by an average of 20% in some urban areas, same as vehicle prices. But despite all of these inflationary pressures, the US economy still appears strong, as despite the fast rising prices, demand hasn't waned or slowed down, nor has it shown any sign of weakening. In other parts of the world, inflation pressures bite even harder. Many seasoned investors and financial experts have, however, begun to express their concerns that the economy might, however, soon start to slow, especially as interest rates increase, and in an event that would mark the official onset of stagflation. High interest rates and high inflation rates are a terrible mix for any nation's economy, and have long been the hallmarks of stagflation. Leading US economists like Edward Yardeni have given their expert view on what's presently unfolding in the US economy, and which might soon spread out to other parts of the world, where its impact would even be more profound. In their opinion, signs of stagflationary pressures were already evident within the US economy. Even before the Russia-Ukraine war broke out, inflation was high, and peak inflation was projected to occur in April, before receding to around 3 to 4% according to forecasts. But with the ongoing war and persistently high commodity prices, inflation rates have remained high as against projections and seem poised to get even higher and ultimately birth a wage price inflationary scenario. These experts completely agree the ongoing situation seems like a holy repeat of the 1970s all over again. In their opinion, and since the outbreak of the war, stagflation is the most descriptive terminology for explaining the scenario that's been unfolding in the last couple of months and that will continue for several months to come. Now, they project inflation rates to go even higher and the rate of economic growth to become stagnated or move very slowly. Now, authorities seem poised to raise interest rates but plan to do so at a very slow and calculated pace. But even that, according to these experts, would do very little to combat the now pervasive stagflationary pressures. Another question that arises with raised interest rates is how the government intends to tackle inflation, especially with the geopolitical mess in Eastern Europe. But the honest reality, according to Yardini, is that the Fed is largely incapacitated and there's very little it can do at the moment to keep inflation in check, as the only tool it has to do this is to raise the interest rate, an attempt that is very likely to prove counterproductive with the ongoing complicated situation. Stagflation is realistically very scary, and as it stands, the inflation rate can very much rise to as high as 9 to 10%, and top firms in the US are already estimating that their stock value might plunge by an estimated 5% over the next decade. Restructuring your investment portfolio at this point is near impossible, and at best an effort at futility. To truly understand the phenomenon of stagflation and its impact on the US economy, especially in the light of recent dynamics of the world, it would be expedient to go back in time to the 1970s, when stagflation occurred due to monetary and fiscal policy implementations during the season of an oil embargo replacement. Interestingly, many economists view stagflation as a myth and deemed it virtually impossible before the 1970s, given that unemployment and inflation rates moved in opposite directions. It was just pretty difficult to fathom how a stagflationary situation could occur. As demand for commodities increases, prices naturally go up, and this enables establishments to expand and hire more hands, which invariably sustains the demand level. But the great inflation of the 1970s, which marked the onset of the years of stagflation that dominated the period, began, and it became glaring that stagflation was indeed possible, given some unique conditions. The US economy during the 1970s stagflation period was essentially dotted by four core characteristics. There were high global oil prices, coupled with high inflation, a high unemployment rate, and a concurrent recession. By November 1979, the price of oil had surpassed $100 per barrel, before going on to peak at $125 just a few months later. Inflation was also abnormally high, and way above the acceptable 2% threshold around this time, and rose to as high as 13.5% in 1980. Unemployment was likewise widespread and consistently high, and by the early 1980s, it peaked at nearly 10%. With this rather unprecedented mix of events, the US economy soon nosedived into a nasty recession, which left the chair of the US Federal Reserve at the time, Paul Volcker, with no choice but to adopt very drastic measures, which gradually helped stabilize the economy and wipe out inflation. By the mid-1980s, the US economy was already fully rejuvenated and was on the brisk of another boom season. Coming back to our present reality, there's very much no doubt that we're in a period of full-blown inflation, given the persistent increment in commodity prices. While this fact has been established, the crux of contention and debate right now remains just how long the inflationary pressures would last. Would it be short-lived or would it persist for a grueling and extended period? To answer this, one interesting data point is perhaps very pertinent to look at in understanding just how very quickly commodity prices have risen so far in 2022. A shocking finding from a recent study revealed that grocery prices at Walmart have increased in cost more in the last 6 months than they did in the last decade, from 2011 to 2021. So as it stands, high inflation rates as experienced in the 1970s presently exist, only continue to show signs of increasing further, despite the economy being strong by several other metrics, as was likewise the case back then in the early stages. Now, the soaring concern among finance and economic experts, as well as other everyday Americans, is the economy might soon begin to slow down as was the trend in the 1970s, especially as interest rates begin to rise. If the inflation rate remains persistently high in the face of the rising interest rates, then the economy would undoubtedly get eclipsed by the much-dreaded stagflation pressures. To put all these in perspective, the interest rate on a 30-year mortgage was a mere 2.7% as of February 2021, but it presently sits at 4.7% and has left an increasing number of Americans with far less money to spend on other things, especially necessities. And while interest rates might still appear low in the context of comparative historical analysis, all of these scenarios continue to collectively raise very important questions that beg for answers, especially how and what the average Americans can do to protect themselves and their incomes from the dreadful impacts of stagflation. The glaring and known answer to this remains a diversified portfolio of investment in great companies with viable stocks. To make sure you're making the right investment decisions in protecting yourself from the devastating consequences of inflation, it'll be great to understudy seasoned and great investors who've retained their wealth despite going through many different seasons of economic downturn. It's likewise very important to note the wrong decision you can make during a period of extreme stagflationary pressure, as this is cash. Do not hold physical money in cash or save it in your bank account, as it would continue to get greatly devalued with inflation rapidly eating away its purchasing power. The return on cash held physically or saved in the bank is always almost 0%, and this should leave you with absolutely no need to hold an excessive amount of cash. As an investor, you should also pay great attention to the expected yield of your investment, especially in terms of their real returns, by simply comparing the annual yield on your portfolio of investments to the prevailing inflation rate. Always make sure to leave no stone unturned towards maximizing the returns on your investment in real terms. Stagflation has ceased being an impossible economic scenario since the 1970s, and the world is presently on the verge of another stagflationary period from all indications. Protecting yourself via rational investments that yield the highest possible real returns is one great safety net you can key into till the economy stabilizes. If you enjoyed watching this video, you might want to check out our video on financial education and the rules of money.